The shift is happening right now. Over the past 24 months, not in some faraway conflict, not in a news headline you saw casually, China has moved more than $8 trillion of foreign assets, reserves, and trade relationships. $8 trillion. That is more wealth than the entire economy of Germany. That is more economic output than Japan produces in a year. That is more than the GDP of every single country in Africa combined. And here is what makes this terrifying. This exact playbook has been written in history 3 times before. The sequences, the stages, the outcome, same pattern, same sequence, same devastating ending every single time. But most people have forgotten this pattern. It's not taught in modern economics classes anymore. History books scrub it out or reduce it to footnotes because the lesson is too powerful, too dangerous, too threatening to mainstream belief systems about globalization, trade, and peaceful cooperation. If you understand this pattern, you will see what is happening with shocking clarity. If you don't, you will be blindsided. We are not at stage 1 anymore. We are not even at stage 2. What is happening right now is stage 3, strategic repositioning, and the collision is becoming mathematically inevitable. By the end of this video, you will see exactly what China is doing. You will understand why Western investors who don't see this pattern are about to lose everything, and you will know the time frame for when the breaking point arrives. Let's start with the pattern itself. The pattern they don't teach you in school, the sequence erased from textbooks because it reveals how history really unfolds when economic power shifts. Every single time a rising power challenges an established economic empire. The following 4 stages play out, always in the same order, always with the same outcome. 1. Foundation of dependency. 2. Asymmetric accumulation. 3. Strategic repositioning. 4. Controlled demolition. Every empire that fell economically, every currency that lost its dominance, every nation that was eclipsed went through these stages. In stage 1, 2 powers become deeply interdependent. Trade flows become massive, capital flows freely. Each believes they need the other. Economists celebrate mutual benefit, politicians praise cooperation, and journalists proclaim a new era of peace through economics. People assume this won't ever end. It always does. In stage 2, one side begins accumulating strategic advantages while the other grows complacent. The rising power saves, diversifies, builds reserves, positions itself. The dominant power spends, borrows, assumes stability is permanent. Power shifts quietly, invisibly, until suddenly it isn't invisible anymore. In stage 3, the rising power has built enough leverage that it begins quietly restructuring its economic footprint. It diversifies trade, builds alternatives, peels away dependencies, all while maintaining the facade of cooperation. This is the dangerous phase, because to the outside world it feels normal. Diplomatic meetings are polite, trade continues, headlines are unfazed, but behind that polite exterior, economic war is being prepared. Then comes stage 4, controlled demolition. This is where the rising power triggers the collapse deliberately. They weaponize the very dependencies they spent decades building. They use economic firepower to achieve political and strategic objectives without firing a shot. The established power is trapped by debt, by consumption, by markets, by arrogance, and collapse is not in military defeat, but economic implosion. This is worse because it cannot be fought with armies. You can only watch it happen. Let's look at history to see how the pattern unfolds. The first clear modern example happened between Britain and Germany from 1900 to 1914. At the turn of the century, the British Empire was the largest economic power the world had ever seen. It controlled a quarter of the planet, the pound sterling was the global reserve currency, and London was the heart of finance. Britain seemed eternal, invincible. Germany was industrializing rapidly, but how much of a threat could it really be? At first, none at all. Trade between Britain and Germany flourished. Economists wrote about how mutual trade made war impossible. Politicians praised cooperation. The powers seemed permanently interlinked. But behind the polite rhetoric, Germany was quietly restructuring its financial position. Between 1900 and 1910, Berlin reduced its British pound holdings by 60%, a massive repositioning. They accumulated gold instead, building the largest reserve in continental Europe. They cultivated trade relationships across Eastern Europe and the Ottoman Empire, creating parallel economic networks outside British financial dominance. In private banking conference minutes, German financial officials openly discussed financial warfare strategy, how to weaponize gold reserves, how to trigger bank runs in London, how to collapse the pound without firing a shot. This was not theory. This was planning, preparation, execution. Then in August 1914, when war erupted, financial warfare erupted too. Germany froze British assets in German banks and recalled gold held in London. This triggered a liquidity crisis that nearly collapsed the Bank of England in the first week of the war. Britain had to suspend gold convertibility and beg the United States for emergency loans just to survive. The result? The pound never recovered its dominance. Within 30 years, The US dollar replaced it as the world's reserve currency. That was stage 4, and the collapse of British financial dominance was complete. The second example played out between America and Japan from 1950 to 1990. After World War II, America rebuilt Japan, incorporated it into the global trading system, and created a deep economic partnership. Japan became America's manufacturing engine, electronics, cars, consumer goods, and the US became Japan's consumer market. Stage 1 was complete. But by the 1960s, Japan was accumulating massive amounts of US currency reserves, dollars, treasuries, and more. By 1985, Japan held over $300 billion in US holdings. That gave it enormous leverage. Japanese firms bought iconic American assets, Rockefeller Center, Pebble Beach, Columbia Pictures, converting financial reserves into hard assets. The Plaza Accord of 1985, widely described as cooperation to stabilize currencies, was in reality a demonstration of power. Japan used its leverage to force the devaluation of the dollar while reshaping currency markets in its interest. By 1987, Japan was openly planning alternatives to the dollar system. Then came Black Monday, the 1987 stock market crash that wiped out over $1 trillion of market value in a single day. Coordinated selling, massive liquidation of U.S. assets, and leverage in currency markets had nearly collapsed the American financial system. America survived only because the Federal Reserve flooded markets with liquidity at unprecedented speed, essentially printing money faster than the crisis could spread. But the message was clear. Japan had the power to destabilize American markets. That was stage 4 attempted. Japan didn't replace the dollar entirely, but it demonstrated the power of economic leverage and financial weaponry. And China watched everything. The third example unfolded between Europe and Russia from 2000 to 2022. After the Cold War, Europe integrated heavily with Russia. Germany became dependent on Russian natural gas. 65% of its supplies came from Russia by 2015. Europe told itself this dependency ensured peace. Politicians praised interdependence. Economists cheered. Meanwhile, Russia did something subtle but powerful. From 2000 to 2020, it accumulated over $600 billion in foreign reserves and systematically reduced exposure to Western currencies. Russia increased gold holdings by 300%, developed alternatives to SWIFT called SPFS, and built payment networks in cooperation with China. Western analysts dismissed it as irrelevant or paranoid. Then in 2022, Russia invaded Ukraine. The West responded with massive sanctions, freezing reserves, cutting banks off SWIFT, banning energy exports. Western leaders declared victory within weeks. Instead, what happened shocked them. The Russian economy did not collapse. The ruble initially dropped, then recovered within months. And within 6 months, it was stronger than before the conflict began. Russia triggered stage 4 deliberately by weaponizing energy dependency. They didn't cut off all supplies, they only reduced them strategically, enough to create maximum pain without provoking global backlash. The result was energy prices spiking, inflation soaring, industrial production collapsing in Europe, and a recession that will echo for years. Europe didn't lose because of bombs. Europe lost because it depended on supplies it couldn't replace quickly. That is the power of economic warfare. Now we come to the most relevant example of all, China and the West. Starting in the 1990s, America welcomed China into the global economic system. China became the world's factory. Trade between the US and China exploded from billions to trillions per year. American companies outsourced whole industries, textiles, electronics, pharmaceuticals, to China. China accumulated dollars faster than any nation in history. Stage 1 was complete. Then stage 2 began. China didn't just accumulate dollars, it accumulated reserves and leverage. By 2020, China held over $3 trillion in foreign reserves, more than Japan and Europe combined. That enormous reserve gave it leverage Western policymakers barely understood. But China didn't stop there. It began building something else entirely, a parallel economic order. In 2013, China announced the Belt and Road Initiative, which now includes over 150 countries and more than $1 trillion in infrastructure investments. Roads, ports, railways, pipelines, all financed, built, and operated under Chinese standards. Trade dependencies were created across Asia, Africa, and beyond, bypassing traditional Western systems entirely. In 2016, China launched the Asian Infrastructure Investment Bank, AIIB, as a direct competitor to the World Bank and IMF. By 2018-20, China had developed CIPS, a cross-border interbank payment system that rivals SWIFT. In 2018-20, it launched a central bank digital currency capable of bypassing SWIFT altogether. These moves were not fringe experiments. They were strategic repositioning at a scale never seen before in history. And over the past 24 months, the magnitude of China's shift has become unmistakable. China has reduced its U.S. Treasury holdings from over $1 trillion to under $800 billion. That reduction alone is massive, but it's not random selling. It's systematic repositioning. At the same time, China has been accumulating gold at unprecedented rates. Official statistics put Chinese gold reserves at around 2,000 tons, but commodity traders estimate the real figure could be closer to 5,000 tons or more, much of it acquired quietly and off-market. China has signed currency swap agreements with more than 30 countries, allowing them to trade in yuan instead of dollars. Russia now does most of its trade with China in yuan and rubles, not dollars. Saudi Arabia has begun pricing oil in yuan. Brazil, Argentina, Thailand, the UAE, all are entering direct currency swap agreements bypassing the dollar. CIPS, the Chinese alternative to SWIFT, handled 100 trillion yuan in transactions in 2022 and 150 trillion in 2023, a 50% annual increase. This is not an idle system. It is a functioning global payment network ready for mass adoption. China has stockpiled critical physical resources as well, not just financial assets. Strategic metals like copper, lithium, cobalt, rare earth elements, food grain reserves, and oil supplies are all at record highs. China is preparing for disruption, for sanctions, for economic separation. The most important move happened in November 2023, and if you read it carefully, it tells you everything about the timing. China issued an order to all state-owned enterprises to divest from Western markets within 3 years. That means by November 2026, Chinese institutional money must be liquidated out of Western stocks, bonds, real estate, private equity, roughly $8 trillion of total exposure. Make no mistake, this is not risk management. This is not portfolio diversification. This is preparation for complete economic separation. This is Stage 3 verified. We are deep into Stage 3, the quiet phase before the storm, the preparation phase before the demolition. And Stage 4, the controlled demolition, is not a maybe, it is a certainty. Now let's talk about what Stage 4 will look like when it happens. There are 3 coordinated moves China will execute. First, China will dump the remainder of its U.S. Treasury holdings. Not quietly, not gradually, but in a single coordinated wave across multiple markets. This will crash the Treasury bond market, send interest rates soaring, and force the U.S. government into a crisis no printing press can fix without triggering hyperinflation. Second, China will trigger a strategic supply chain crisis. China controls 60 to 90% of manufacturing in critical sectors: semiconductors, pharmaceuticals, medical devices, batteries, rare earth elements, solar panels, electronics. They won't cut exports completely, meaning that would unite the world against them, but they will restrict them strategically. Export permits, quality inspections, processing delays, regulatory reviews, all engineered to create shortages, panic, inflation, and systemic stress. Third, China will offer alternatives: incentives, systems, trade frameworks that bypass the dollar economy, UN-based settlement systems, CIPS instead of SWIFT, digital yuan transactions, gold-backed instruments, better terms for countries that adopt the new framework. And when the dollar system begins to strain under stress, dozens of countries will switch. Not because they want to, but because they have to. This is the economic equivalent of winning a war without firing a shot. And unlike military conflict, there is no defense once the system breaks. Armies won't help. Sanctions won't stop it. There's no battlefield you can fight on. Now let's address the most dangerous lies people tell themselves right now. The lies that will cost ordinary investors, ordinary workers, and ordinary nations everything. Lie number 1. This time is different. China needs America as much as America needs China. Wrong. Mutual dependency doesn't prevent conflict. It creates leverage for economic warfare. Germany needed British trade in 1914. Japan needed American consumers in 1987. Russia needed European energy revenue in 2022. None of them hesitated to weaponize their position when the time came. Lie number 2. The dollar is too big to fail. It is the reserve currency. It can't be replaced. Wrong again. The pound was the reserve currency for over 150 years. Dominance is not permanent, and it is conditional. It requires trust, fiscal discipline, and economic stability. None of those conditions are guaranteed anymore. U.S. debt sits above 124% of GDP. Interest expenses exceed $1 trillion annually. Every time the U.S. uses financial sanctions, it signals to the world a reason to seek alternatives. Lie number 3. America can respond. We have the military, innovation, and economic power. This is the most fatal delusion of all. There is no military solution to an economic siege, and you cannot rewire global supply chains overnight. Semiconductors take years to build. Pharmaceutical supply lines take years to establish. Rare earth processing cannot be relocated in months. This is why the Russian gas crisis crippled Europe, not because of bombs, but because dependencies have lifetimes measured in years. Here is the reality most people refuse to face. Stage 4 is coming. Not maybe, not someday. It is scheduled. The window has been set. China's deadline for divestment is November 2026. That is your marker, your countdown, the period of maximum danger. So what can you do? How do you prepare? How do you position yourself, not just to survive, but to thrive? First, understand the timeline. From now until late 2026 is the window of greatest danger. That is, when China's strategic exit from Western markets completes and when financial leverage reaches its peak. Second, reduce exposure to assets that rely on Chinese manufacturing, cooperation, or dollar dominance. Many major Western stocks, bonds, real estate markets are deeply exposed. When China triggers stage 4, these assets don't adjust, they collapse. Third, position in assets that benefit from economic separation or supply chain disruption. Defense and security-related industries, reshoring efforts, energy independent sectors, food production and food security, these will see demand surge. Fourth, diversify away from pure dollar exposure strategically. Gold is the classic crisis hedge. Bitcoin and decentralized assets provide an alternative outside government currency systems. Foreign currencies from neutral countries, Swiss francs, Singapore dollars, offer ballast. Fifth, prepare for practical supply chain disruptions in your daily life. Stock critical supplies, medicine, electronics now, before prices spike or availability dries up. These steps are not panic, they are pattern recognition, positioning based on historical precedent and structural realities, not wishful thinking. The data already shows insiders acting. Central banks around the world are diversifying reserves and buying gold at record rates. Billionaires are reallocating capital. Family offices and hedge funds are reducing exposure to Western equities. Private equity is liquidating positions in China. Markets are pricing risk through derivatives, all indicating smart money understands the pattern. Now let's make it personal. Think about everyone who ignored history in the past. The Dutch investors who lost everything in the tulip crisis, British holders of the pound in 1914, Japanese real estate speculators in the 1990s, European manufacturers dependent on Russian energy in 2022. All of them believed the system was stable. All of them thought this time is different. All of them were wrong. Those who ignore history do not just lose money, they lose everything. Patterns do not care about belief. They do not care about hope. They do not care about optimism or headline narratives. Patterns care about leverage, timing, and preparation. And right now, the mathematics favor China. Leverage is with China. Timing is China's choice. Preparation is complete. China's $8 trillion repositioning is done. The trap is set. What happens next will reshape the global economy, destroy Western financial dominance, and end the dollar era. Not through war, but through economics. This is not fear-mongering. This is structural inevitability. History repeating itself on a scale larger than anything seen before. The only remaining question is, will you see it coming? Will you position yourself for it? Will you survive it? Will you profit from it? Or will you be another victim, another person who ignored the pattern until it was too late? History is screaming the answer. The data is revealing the answer. The pattern is uncovering the answer. China's $8 trillion move will collapse Western markets. Not might, not maybe, will. The stages are set. The sequence is clear. The trigger is ready. The countdown has begun. What you do in the next 12 months will determine the next decade of your financial life. Subscribe now and hit that notification bell, because in part 2, we will break down exactly which sectors collapse first, which assets survive and thrive, precise timelines for how stage 4 unfolds week by week, the specific stocks that explode during reshoring, the commodities that spike when supply chains break, and the currencies that survive when the dollar falters. Because what's coming will change everything. Everything you thought you knew about investing, economics, global power, and the future of the world order. And understand this, those who recognize the pattern will be the only ones left standing when it's over. The collapse is inevitable. Your response is optional. Choose wisely, act decisively. Time is running out faster than most people think.